Hello everyone, my name is Ariadna Manso. I use she, her pronouns, and I'm the graduate assistant for the NYU's Office of Financial Education. And today we're going to be talking to you about student loan repayment. So just an overview of what we will be going over with you today. We're going to cover loans, repayment, deferment versus forbearance, and we're also going to talk about delinquency versus default, as well as loan forgiveness, private loans, and iGrad. And then we're going to wrap it up with some Q&A. And just to get us started, we're just going to do a brief introduction into our Office of Financial Education. So our mission is to instill quality financial education to empower prospective and current students to make responsible decisions that contribute to their overall success. We know that as students, you are very busy managing your different student demands, and we know that finances can be overwhelming. That's why our office is committed to partnering with current NYU students to provide them the tools and support they need in order to navigate financial choices and make informed fiscal decisions. And to get us started, we're going to be talking about what student loans are. So student loans are essentially money that you borrow for any educational expenses that you have that you then pay back with interest. These loans can come from either the federal government, and those are known as federal student loans, or they can come from private sources such as banks or financial institutions, and those are known as private loans. It's important to note that federal loans do have more benefits than the private loans, so just keep that in mind. The different federal loans out there are the subsidized loan, the unsubsidized loan, the federal plus loan, the parent plus loan, and the graduate plus loan. And for private student loans, we're unable to recommend you a specific private lender. So it's important that you just visit the financial aid's website because they provide a list of reference of all the different private lenders that are out there. And you can go ahead and browse those different lenders to see which one is the better option for you. And so once you decide to borrow either a private loan or a federal loan, these loans are then dispersed to whatever university you attend to help you cover any of the educational expenses that you have. So once your private loans are dispersed, and then you go through your educational trajectory and you graduate, you begin then your grace period at the point of you graduating. And this grace period essentially gives you time to financially settle to be able to select your repayment plan, which we'll be talking about later in the presentation. However, it's important to know that this grace period will start if you either graduate, you leave school, or you drop below half-time enrollment. And for half-time enrollment, that's for undergraduate students, that's at 6 credits. And for graduate students, it's at 4.5 credits. So just keep in mind that this grace period will begin if you either graduate, leave school, or drop below that half-time enrollment. And so once your grace period starts, and let's say you go back to school, then your grace period gets put on pause, and then it repeats every time you're in school. However, you only have one grace period. And this grace period does last 6 months. So it's important to know that you only have a 6-month grace period, and that it begins after you either graduate, leave school, or drop below half-time enrollment. And it's important to know that not all federal loans have a grace period, and that federal loan includes the Parent Plus loan. So just make sure you understand that. And for private loans, you want to make sure that you check with your private loan borrower to see if they offer grace period, because each has different deferment terms and conditions. So you have to look to see what their terms and conditions are in order to borrow that. So now we're going to be going over the different repayment plans that are out there. Before we go over that, we're just going to give you examples of what monthly repayment can look like depending on how much you borrow. So if you are an undergraduate student and you borrow the subsidized loan that you've been offered for all 4 years, so you borrow the max amount of the subsidized loan that was offered to you, you're looking at a repayment of around $181.28 per month. If you borrow the full unsubsidized loan that is offered to you for the 4 years that you intend undergrad, then you're looking at around $76.33 that you're going to be paying every month. If you borrow both of these, the subsidized and the unsubsidized loan for the 4 years of undergraduate school, then you're looking at a repayment option of around $260 per month. So it's important to note this. And when you're looking to borrowing and the amount that you want to borrow per year or for your entire undergraduate career, you can use different student loan calculators that are out there that can give you these estimates, just as we were able to obtain those for the purpose of this presentation. You can also look at them for the purpose of understanding what borrowing a certain amount at a certain interest rate will mean for you in the future. And of course, there are also private loans. So when thinking about borrowing a private loan, you also want to look at the different interest rates because they do vary depending on what private loan you borrow. So for this example, we took out a $20,000 private loan at a 6.8 interest rate. So you're looking at a monthly repayment of $230.16. And if you're thinking about going to graduate school, there are two federal loans that can be offered to graduate students. And so one is the unsubsidized loan and the other one is the Graduate Plus loan. So for the unsubsidized loan, there's a max that graduate students can borrow per year, and that's $20,500. So if an undergraduate student borrows the max that they were offered for 1 year at $20,500, they're looking at a monthly repayment of $210.49. Now for the Graduate Plus loan, the max that a graduate student can borrow is up to their cost of attendance. So for this graduate student, if they borrowed a $30,000 loan, they're looking for that 1 year, they're looking at around $322.61 for a monthly repayment plan or repayment option. So if the graduate student borrows both of these loans for 1 year, they're looking at a monthly payment of around $533. But now keep in mind, if this graduate student also borrowed loans as an undergrad, if they borrowed both the subsidized and unsubsidized loan as an undergrad for all 4 years, and on top of that, they borrowed this $20,500 unsubsidized loan and a $30,000 Graduate Plus loan, then they're looking at a monthly repayment of around $790. So just keep that in mind. As an undergrad, if you do plan to go to graduate school, it's just keep that in mind of looking at the total amount of borrowing that you're going to be doing. And now, we're just going to move into repayment plans. So there's various repayment plans that exist out there. And to determine which payment plans are best for you, you must be aware of your financial situation. So although you may select or be assigned to a repayment plan when you first begin repaying your student loan, you can change your plans at any time for free. You just need to contact your loan servicer about it. So for the first repayment plan, you'll usually pay less over time than other plans, and this is the standard repayment plan, because your monthly payments might be slightly higher than the payments made under other plans, but you'll pay off your loan in the shortest time. So for this reason, you will pay the least amount of interest over the life of your loan. And so for the standard repayment, and that's for the standard repayment plan. And these payments are fixed amounts that ensures that your loans are paid off within 10 years. The fixed amount is of at least $50 each month. So for the graduated repayment plan, payment plans are lower at first, then they increase usually around every 2 years and are for an amount that ensures that your loans are paid off within 10 years. So if your income is low now, but you expect it to increase steadily over time, then this plan might be the best one for you. The other plan is the extended repayment plan. And for this plan, payments are fixed or graduated, and they ensure that your loans are paid off within 25 years. However, for this plan, you must have more than $30,000 in outstanding direct loans to be eligible. And now we're going to talk about the repayment plans that are income driven. And so these repayment plans, there's different types of them. And so for the first one, the revised pay as you earned, also known as repayment plan, payments are 10% of your discretionary income, and they're recalculated every year based on your updated income and your family. The next one is the income-based repayment plan, also known as IBR repayment. And these payments will be either 10% or 15% of your discretionary income. And payments are recalculated each year. And for this one, you must have a high debt relative to your income. Then the next one is the income sensitive repayment plan. And for this one, your payment is based on your annual income, but your loan will be paid in full within 15 years. Then the last one is the income contingent plan, also known as the ICR repayment plan. And for this one, your payment will be the lesser of either 20% of your discretionary income or the amount you would pay on a repayment plan with a fixed payment over 12 years and adjusted according to your income. So those are the different income-driven plans that are out there, in addition to the first three that we covered. So now we're going to go over deferment, forbearance, as well as delinquency and default. So for deferment, it essentially allows you to temporarily stop making payments on your federal student loans, and forbearance allows you to either temporarily stop or temporarily reduce the amount you pay. During a forbearance, you can either pay the interest as it accrues, or you can allow it to accrue and be capitalized, meaning added to the principal amount of your balance at the end of the forbearance period. If you don't pay the interest on your loan and allow it to be capitalized, the total amount you repay over the life of your loan may be higher. And any unpaid interest is capitalized only on direct loans and the federal family education loan. Unpaid interest is never capitalized on the federal Perkins loan. So for deferment, you're generally not responsible for paying the interest that accrues on your subsidized loan, but you are responsible for paying any accrued interest on any unsubsidized and plus loans. For forbearance, you are responsible for paying interest that accrues on all of your federal loans. It's important to note that for most deferment and forbearances are not automatic. So you need to submit a request to your student loan servicer, also known as your student loan lender, on a form, and you must provide your student's loan servicer with the documentation to show that you meet the eligibility requirements for the deferment. All deferment and forbearance are available to direct loan, the Federal Family Education Program, and the Perkins loan. You must continue to make payments on your student loans until you have been approved by your loan lender for either deferment or forbearance. If you stop paying your deferment is not approved, then your loans will either become delinquent or default or go into default, which we will be going over right now. So delinquency essentially is when your loans essentially means that your loans become delinquent the day after you miss a payment. And your loan account will then remain delinquent until you pay the full past due amount. And your loan servicer will report the delinquency to all three major credit bureaus if your student loan is more than 90 days delinquent. So you really want to avoid missing any payments on your student loans. Your loan then goes into default if it continues to be in delinquency status. An entire unpaid balance and any interest you owe on the loan is due if it goes into default, and you're also no longer eligible for deferment or forbearance, and you lose the ability to choose any type of repayment plan. You also lose federal student aid eligibility, and your default is also reported to all the three major credit bureaus. And in addition to all that, your loan servicer can also take you to court. So you really, really want to avoid for your loans to go either into delinquent status and then go into default. So with repayment, you always want to understand that things can change. So your lender can change things at any time. So it's always important to establish a relationship with your lender, as well as become familiar with the different options that you have out there, as well as with the different systems that exist, such as like visiting the federal student aid website and familiarizing with it. And because, like I said, a lot of changes can always happen. And one example is right now, currently with COVID-19, federal student loans as of March 13th up until December 31st of this year of 2020, student loan payments were suspended. Collections have been stopped on all defaulted loans, and interest rate on all Department of Education owned loans have been lowered to a 0% interest rate. So as you see, there's different changes happening. So you always want to make sure that you stay on top of understanding what these changes are and what they're going to mean to you and your different repayment options. So now we're going to just talk about the different types of federal loan forgiveness that exists out there that you may be eligible for. So the first one is a teacher loan forgiveness. For this one, there are different requirements that you must meet, but we're just providing some of the major ones. So for the first one is that you must either teach full time for five complete and consecutive academic years. It must be at a low income school or educational service agency. And forgiveness is only on a portion of your direct subsidized and unsubsidized loans. So it's not forgiveness on the entire loans that you owe. And you can go to studentaid.gov for any other qualifications that they have, as they do have more, and these are just some of the major ones. The other type of loan forgiveness that exists is the Get on Your Feet loan forgiveness program. This one is only for New York State residents. You can be provided of up to 24 months of federal student loan debt relief. However, you must be a recent New York State college graduate participating in a federal income-driven repayment plan. And there are other requirements that you must meet. So you can go to hesc.ny.gov to get that information. The other type of loan forgiveness that exists is the Public Service Loan Forgiveness, which was created under the College Cost Reduction and Access Act of 2007 to forgive any remaining balance of your federal student loans. As with the others, this one also does have its certain requirements, which we'll be going a little bit more into depth. So one of the requirements are making 120 qualifying monthly payments, being enrolled in a qualifying repayment plan, and working full-time for a qualifying employer. So how does the public service loan forgiveness work? So essentially, you must certify your employment yearly via the Public Service Loan Forgiveness Employment Certification Form. You must make 120 qualified payments, so it's important to keep track of your payments. Your repayment plan needs to be in an income-driven plan, and you need to recertify it annually. And you need to apply for loan forgiveness via your loan servicer after making 120 qualified payments. You can make qualifying payments only during the periods when you're required to make a payment. Therefore, you can't make a qualifying monthly payment while your loans are in either in school status, while you're in your grace period, or while you're in either deferment or forbearance. And your qualifying payments do not have to be made consecutively. So that's important to know, but it's just important that you understand that those payments do have to be 120 qualified payments. And then after that, you're able to apply for loan forgiveness via your loan servicer. So who is eligible for public service loan forgiveness? So those employees that work at either the federal, state, local, and tribal governments, those employees that worked at tax-exempt 501c3 organizations, and employees that work at nonprofits that provide designated services. The position does not matter as long as you're an employee at either of these, and that you're doing full-time work, and that you're classified at 30 hours a week. And you can have multiple part-time jobs and still qualify for public service loan forgiveness. Employers that do not qualify are labor unions, partisan political organizations, for-profit organizations, including for-profit government contractors, and not-for-profit organizations that are not tax exempt under 501c3 of the Internal Revenue Code, as well as those that do not provide a qualifying public service, such as for their primary function. The loans that are eligible for public service loan forgiveness are the subsidized loan, the unsubsidized loan, the PLUS loan, and any consolidated loans that are only federal direct loans. The eligible repayment plans, as I mentioned, are the income-driven repayment plans, and those are the revised pay-as-you-earn repayment plan, the pay-as-you-earn repayment plan, the income-based repayment plan, as well as the income contingent repayment plan. It's important to keep in mind that this is that this is what is current, but as I mentioned earlier, it might change in the future. So it's important to understand what you may be eligible for and just kind of stay up to date with that. So I know, you're wondering, do private loans qualify for public loan forgiveness? And unfortunately, private loans do not qualify for student loan forgiveness programs, but you may have other options depending on your loan lender, such as the deferment option, the forbearance option, or the refinancing option. So it's important to speak with your private loan lender about what different options you do have. And student loan consolidation is also something that is an option for you. And that's essentially when you combine multiple of loans into one. And the lender will essentially pay off your current loans and issue you a new loan for the total amount that you owe. And the lender also issues you a new loan based on your credit worthiness. So it's important to understand that. And at the end of the day, you may save money and lower your monthly payment by refinancing your student loan with an interest rate reduction. So speak to your loan servicer about the consolidation options that exist for you. So just kind of to wrap this all up, we're student loans are essentially not bad because they're an investment for your educational expenses, and they can serve part of your educational investment because you're using them to go to school and essentially graduate. But when you are deciding to borrow, it's just important that you are prepared, and that includes understanding how much you need to borrow. And also understanding what the terms of the loan are, such as what the interest rate is. Do you have a deferment option? Also, what your repayment will be in the future in regards to the amount that you will be repaying and how much you will be repaying and for how long. It also includes understanding any future job prospects and how those job prospects will benefit you at the end of the day with this repayment option. And also understanding that things may always change when it comes to your student loans. And so just understanding that you need to be in tune and aware of those changes. And so in addition to and it's also important to understand that once you graduate, in addition to your student loan payments, you will also have other expenses as an individual. And so understanding those expenses, especially the why behind them, is going to be very crucial. And it's going to be important when you start making your student loan repayments, because as we saw for a graduate student that borrowed both in undergrad and graduate, they were looking at a monthly repayment of around $790. So it's just important to understand that in addition to your student loans, you are going to have other expenses. But that is why our Office of Financial Education is here, because we offer you different workshops and events, such as this one, that provide information on budgeting, banking, credit, and we also provide different events, such as the adulting series that we had this fall. We also offer one-on-one coaching, and those topics we cover are budgeting in New York, loan repayment, financing, study away, and other topics. We also offer a great resource known as iGrad, and iGrad offers you different scholarship search options. It also provides budget sheets so you can track your expenses. And it also offers you money quizzes and courses, as well as it provides for you an option to keep track of all your student loans through their student loan snapshots. So it's very important that you do visit iGrad, because they do have all these resources as for you. They also provide different calculators. So if you're planning on buying a house in the future, you can look at what a mortgage will look like for you. And you can also take a quiz to understand your money personality. So it's very important that you visit our website so that you can understand what iGrad can offer you. And with that, we just want to say thank you for tuning in today with us. If you do have any questions, you can always email us at financial.education@nyu.edu, but also stay up to date with our different events that we have and programs by following us either through Facebook, Instagram, or Twitter.